We now come to our final session of the day, which is on professional indemnity insurance review and reform. One little thought that this tickled me, seeing that title, it reminded me of when I was in pupillage as a barrister, and I asked my pupil master if he could define in a sentence the difference between assurance and insurance. And he said, assurance is what you hear in the voice of an old school friend who phones you up after 25 years. Insurance is what he's trying to sell you. Now, I don't think that has any relevance to anything that Crispin Passmore is about to tell us, but ladies and gentlemen, Crispin's session, I think he's going to talk for about 35 minutes or so, and then there will be an opportunity for us to have questions as we did this morning, so please have those ready to go. But in the meantime, please welcome Crispin Passmore, SRA Executive Director of Policy.
Thank you very much. I don't know what I can talk about, chocolate bars or types of lawyers or types of insurance. I think that's probably a little bit difficult on a subject as exciting as this. So what I'm going to do is just run through some of the data, some of the analysis we've been doing on data that we got from insurers and some other things about the legal market that we know that relate to insurance. All of the slides, there's a big pack of slides here. I'm just going to use some of them as we go through, but all of them are published on our website whilst I'm standing here, I think. So there'll be lots that you'll want to look at, and there'll be lots that you'll want to come back to us, I expect, and say, you know, you should think this should happen, or it tells you this. Really interested to hear views, not just today in the questions, but actually in the next 2 or 3 months as we're trying to take what this tells us into a set of proposals for reforming professional indemnity insurance. You might say, why reform it? Well, I think as we go through the data, that might answer some of your questions as why we think we need to make some change. But the key is it's expensive. And it is an inhibitor to people doing different things in different ways. So we need to make sure that we get the right protections that work for consumers in the right way. As I said, I won't stop on every slide. I think the thing to remember at the moment about indemnity insurance is it's more expensive if you're a small firm. It's a bigger proportion of your turnover. It's about 7% of the turnover of sole practitioners compared to only 3.2% for firms 5 to 10 partners. It's a good time for buying insurance. There's good times and there's bad times. It's a reasonably soft market. I would say that's the time to make the changes when the market is softer. I think the other thing to say about the market at the moment is that the insurance is set in a way that works across the whole of the legal market, but the claims come from very specific areas, and we'll get into that as we go through. And it's also an expensive process for resolving claims. Again, you'll see some data on some of that. So the market at the moment is dominated by 3 big insurers. You probably know that because probably vast majority of you are insured with those 3 insurers. But there's only 38 insurers in this market. There's quite often a lot more insurers in a professional services market, sometimes 50 odd or 60 insurers working in a market. So what is it about the requirements that we put in place that make insurers not want to write in this market? Well, perhaps we'll see as we look at the minimum terms and conditions and the nature of claims that exist. It's an interesting market, as I say, compared to others. It's one of the biggest professional services market, not quite the biggest, but it's got the broadest cover. There's very, very difficult to find any other professional services market where the insurance that you're required by your regulator to buy is as broad and as deep as the insurance that we require of you. And it's quite hard to find other legal jurisdictions around the world that have similar sorts of covers as well. So either we're out of step or we're best in class. We'll have to make our mind up as we go through. As I said, it's a reasonably soft market at the moment, but that's not going to last forever. And one of the reasons for that is cybercrime. You know, it's something that probably you're facing more of an issue. I know it's been part of our risk outlook, and one of the sessions today has talked about cybercrime. It's something the insurers talk to us, the banks talk to us as much as they possibly can. They live in fear of this. I suspect many firms live in fear of it. If you're handling client money, if you're doing conveyancing transactions, then you're at risk, and your insurance will go up as that risk grows over the next few years. The cost of premiums, as I say, sole practitioner is high. The premiums are significant. But what's also changed is, despite it being a soft market, the cost of run-off cover seems to be going up. So what's going to happen when we get into a position where the market gets tougher again? Why is it going up? Hard to tell. Insurers tell us about half of firms that close don't pay the premium. So everybody else pays that premium because the insurers remain on risk because our minimum terms and conditions require it. That seems quite odd to me, that the insurers have to provide cover that the firm, the client, their client hasn't paid for. And it probably seems odd to some people that are having to pay more for their insurance to cover that cost, because insurance don't offer that for nothing. I think it also affects the way that insurers price. I think that if you're insuring somebody who was a sole practitioner, who was perhaps getting closer in age to a point when they might want to retire, why would you want to insure them? If there's a chance they're going to close their firm down, you're going to be left, possibly if they don't pay the premium, on 6 years' worth of cover. So it distorts the market as well. We think it's a barrier to orderly closure. It's a significant part of the interventions that we do as an organisation that cost so much money. Again, money paid by those that remain in the legal market to help us close down and pick up the pieces from disorderly closure. Around 20% of interventions arise from poorly closed firms, the poorly closing down of those firms. And we know, as I said, that if you're sole practitioner, or if you're two partners and you're getting closer towards retirement, you're likely to be thinking about when I might put my firm into runoff, when I might want to close my firm. With the demographics of the legal profession, that's a real issue, and that issue is going to become more of an issue over the next 10 or 20 years. We need to get the structure of the insurance right now so that it offers the right consumer protection and that it's actually paid for, because the market will collapse very quickly if a huge number of people close down their firms, don't pay the premiums, and everybody else has to pick up the pieces. So the main fun of this data is the data we've got from insurance companies. We persuaded the insurers to hand over to us details of claims that they'd received over the 10 years, 2004 to 2014. It covers about 90% of claims of the insurance market of the firms that are currently in the market, so it doesn't cover those firms that have left the market in recent years. 142,000 claims. That includes block claims, so some of those will be where there's multiple claims arising from one incident, and they'll be described as one claim, so we deal with them slightly differently. What we've done over the last 12, 15 months is to take all of that data, working with a third party, to recode it and build a tool that allows us to analyse it. Key headlines down in the bottom corner, that over that 10 years, £2 billion was paid out on those 142,000 claims. I can't decide, is £2 billion a big number or a small number over that 10 years? It's certainly a lot of money, but when you think about that 142,000 claims over 10 years, that's only 14,000 claims over each year, which with 10,000 law firms doesn't seem very big. So I think that's quite reassuring. Actually, there's not huge numbers of negligence claims within this market, but certain things drive where those claims come from. It's conveyancing, it's conveyancing, and it's conveyancing, and it's commercial as well. And everything else is trivial within these numbers. That raises real challenges for us as a regulator about how we regulate conveyancing, and I'll come on to that a little bit. But also it raises questions about the nature of our requirements. Do all commercial clients need the same cover, the same minimum terms as somebody doing their conveyancing or somebody getting advice over a will or something like that? Probably not. If they do need the same, then perhaps the commercial client is more able to make a decision about what sort of insurance they want. It's almost certain that they'll want more than 2 or 3 million, which is our minimum cover at the moment, which is why about half of firms go above that level. I think we have to ask, what's this for? Is it to protect all consumers equally, or is it to protect consumers that face particular risks? Is our reason for putting this requirement onto firms offering advice only to commercial clients the same as it is for those offering retail legal services? So what's the reasons for claims? Well, you know, it's not really a surprise. I don't really think this is simply people don't know the law. I think this is about something else than that. These are mistakes in systems, sloppiness, poor supervision, those sorts of issues. And they're the sorts of things that can happen at any time when you're delivering any sorts of goods or services. And to a certain extent, we should accept this is the feature of delivering those services. But we should also be trying to look at it and say, what can we learn? How can we reduce the volume of these? How can we make any other interventions? And say we, I mean us as a regulator, you as law firms, you as individual professionals. How can we try and avoid these sorts of issues so that the pie that we have to insure is a smaller one in the future? So those 142,000 claims that I mentioned leading to £2 billion, only 1 in 5 of them actually leads to a payment. About 75% or so don't get any payment at all. And within that, almost half of them are covered on the pie chart on the right by payments up to £10,000. So there's lots of small payments, and then there's a few very big payments as well. But I think that the 1 in 5 resulting in a payment is quite interesting as well. Insurers tell us that in other professional services markets, those numbers are very different. Many more of the claims notifications actually lead to a payment. So either because of the culture insurers are requiring from you or the culture within your firms, you're notifying many more things than other professionals are. In some ways, fine. You know, it doesn't lead to a payment, it doesn't do any harm, but it costs money. Each of those ones that has to be considered, has to be closed down. That costs money, and that is reflected in the premiums that you're paying. So we need to just think through with you and with insurers what we can do about that in the future. So where does the money go? As I said, it's on conveyancing. What's the distribution of claims? How big are they? Well, what you can see here on this chart is looking across all claims, you can see the percentile distribution by value. If I look on the second bar just here, this one, 98% of claims are covered by up to £580,000. So if we set the minimum level of cover at £580,000 and said you're not allowed to go above that, of course you are, if we said that was the limit, then 98% of claims would still receive their full compensation. We're not suggesting that you wouldn't bar anybody from going above it, I'm just trying to illustrate. Now, if we look at what's that in real terms, what's that in real numbers, given we talked about 142,000 claims? Well, the 99th and the 100th% amount to about 565 claims over 10 years. At least 165, possibly a few more of them are from commercial clients. Quite a few of them are over the 2/3 million already. So what we're really looking at is if we set the limit, for example, at the 98th centile at 580,000 people, then about 20 or 30 people a year would have had their claim limited to £580,000. So the challenge for us as a regulator is to try and strike that balance. Because of course you can't cover all people all of the time. You can't have absolute protection. We don't at the moment. We only require 2 to 3 million. But where's the right place to strike it? Where's the right distribution, the right volume? How do we get the balance between keeping the costs down so that in a competitive market, the price of legal services can fall and we can help more people? And how do we make sure that those few rare occasions when it goes wrong, people are properly protected? We've got to decide whether the 98th centile, the 99th centile, the 100th or close to the 100th is the right number. So we're trying to work through that. I think these numbers help with that debate. This is where we take out block claims and the numbers come down slightly. So you could perhaps say that 560,000 is the right amount. We also, as you know, at the moment have unlimited sideways cover in the insurance requirements, which means that it's 2/3 million for any one claim. But if you have lots and lots of claims, then it's each and every one of those claims that is covered up to £2 or £3 million. That's expensive cover. What that means to insurance companies is even when they know all of this information, even in the case when they know that 98% of claims will be under £580,000, they know they're on risk for that catastrophic element up to £2 or £3 million. So what do? They reinsure that risk. That costs them money, and that's reflected in your premiums. So if we brought that down, that would reduce the cost. Similarly on aggregation, if they're at risk unlimited, even though they know it's unlikely, they will reinsure. How much that costs depends on the structure of their reinsurance, which will depend on that insurance company's risk appetite. It will depend on its capital base, its strength. It will probably change from year to year on its balance sheet, all of the things that you would expect. But what we know is that unlimited cover is expensive and it's probably not needed. So we looked at the data to work out for each individual firm what would be the distribution of aggregate claims, so aggregating all firms' claims together for firms in any particular year. And what you can see is, again, if we just take the 98th centile, 98% of all claims in aggregate for any individual firm would have been settled for less than 1.6 million. You probably don't need unlimited. Now, 1.6 million might be too low, but perhaps 5 million or 10 million might be a sensible place to put an aggregation limit. It will only make a marginal difference to the cost of premiums, but that's the nature of this as a beast. How can we make marginal differences to the cost of the insurance so it's proportionate, responsive to the actual claims that people make, but doesn't get in the way of you running a profitable business that can be grown and help more clients. Similarly, with the other one, we took out block claims and it reduces it down from 1.6 to 1.5 million. So then trying to break out different areas of work and the distribution in those. This takes some just key areas of work and looks at the 98th centile. Commercials where the biggest values go, the big claims are concentrated there. What's interesting is that they're above the 2 million limit and they're quite close to 3 million. Firms tend to reinsure. We'll come on to that a little bit in a minute. But actually beyond the commercial work, claims are surprisingly small, or surprising to me that they were as small as they are, that almost all claims come out at a lower level than perhaps I expected. I expected conveyancing to be reasonably high, but it's lower than I thought, and actually the other ones are very, very much lower. So this again looks at the same areas, but looking across different distributions of it. Again, you see in aggregation that the limits go up because you're aggregating claims together, but still they're not huge. Again, you probably don't need unlimited claims, unlimited sideways cover, even in commercial work. You certainly don't need unlimited sideways cover in conveyancing, or employment at the other end of it. So we looked at maximum value as well. Other than employment, family and other, they're all above the 2/3 million that we require, which means that firms make sensible decisions about the level of cover. You don't need your regulator to tell you what that level of cover is. You make your own assessment. About 50% of firms go above that 2/3 million minimum term at the moment. And that's why, because there is a chance you'll get a big claim depending on the work that you do. So again, we've always got to remember that our minimum terms, the clue's in the word minimum. You can, of course, go over, and of course, you're under an obligation under our expectations of you to have adequate and appropriate insurance. So you need to think about what the insurance cover that you have is. Some have even argued, certainly some people in the LSB have argued to us that perhaps all you need is a requirement to have adequate and appropriate insurance. And we know that that's what happens in medicine. And of course, doctors can actually kill you, which, according to this, I don't think lawyers do. So we looked again across the mean value. So the previous one was the maximum value. This is the mean. So again, you can see the numbers, you can see the patterns. They're not hugely surprising. And we looked at the median as well. Again, you see the patterns. Conveyancing is the big one with commercial. There's just a lot more claims in conveyancing than there are in commercial, which is why that's where all the money goes. We've looked also at run-off cover. This is using data from the old Solicitors Indemnity Fund. I think most people recognise you get more claims in the first year and then they tail off over 6 years. This gives us quite a good pattern of that. I'll move on and show it to you actually in an easier way. If you look on the chart on the left, you see the distribution. At 6 years, you get quite close to 90, just over 90% by value of claims during run-off cover. So, perhaps 6 years is the right number. And perhaps when we suggested 2.5 years ago that 3 years might be the right number, perhaps we didn't get that right, and that's why we didn't go ahead with it. We've now got the data that helps us get to 6 years as a sensible position. But we don't just look at it by value, we look at the volume of claims as well, and it's very similar. But it's probably not much of a case for going beyond 6 years. So within the £2 billion that's paid out, I was surprised to discover that 0.6 billion was defence costs. So this client protection regime, just over a quarter of the money that was paid out was paid to solicitors. So we've also looked at the prosecution costs in that. Obviously, there's claimant costs in successful claims. We're still working with insurers to try and get a handle on the exact values of that. But I think what most people are telling us is that claimant costs will be higher than defence costs. So we quite easily be in a position that more than the half of the money that is in a client protection regime is being paid not to consumers, but to solicitors. It looks more like a recycling scheme than a consumer protection scheme. So we've got to think again about, have we got this right? Is the money going in the right places? What I think is scary is lots of the defence costs go on small claims. That doesn't seem to me to be proportionate. It seems to me that we're building costs into premiums in order to protect against claims that are often only a few £100s. There has to be a better way of giving that sort of consumer protection and getting the right proportionality in it. So just a quick focus on conveyancing. As I've said, it's a disproportionate level of claims within conveyancing. We've looked at residential, commercial. Some of the insurers don't specify the difference and just have it recorded as conveyancing. And you can see over there on the left-hand side in purple as well, stuck out as a smaller piece of pizza, landlord, tenant, lettings and property. So, that whole property issue is a significant driver of claims and therefore of the cost that you're paying in your premiums. So just looking at conveyancing, and that's percentile distribution, 98% of claims for indemnity, when indemnity payment are made, are settled for under 520,000. Interestingly, when we tried to bring the limit in at 500,000, we did some work using old SIF data before we had this fabulous data set, and we got to about 500,000 being the 98th centile. So now we've got better data. We found out we were wrong, it's 520,000. But it shows actually that the instincts you have around this stuff are quite often not far off right if you talk to enough experts. So again, looking at aggregation across conveyancing, the 98th percentile, 98% of claims in aggregate for a firm would be settled for less than 1.2 million. You don't need unlimited sideways aggregation. It's expensive. You don't need it. So reasons for claims. In conveyancing, you'll know this if you do conveyancing. You'll know this if you've been a conveyancing client, I guess, as well. It's not simply that people don't know the law. It's failures of systems, it's failures of supervisions, it's failures of process, it's sloppiness. It's all of the things that any of us can do when we're driving and we make a mistake. It's not that we don't know how to use a roundabout or don't know to stop at a zebra crossing. We just made a mistake. And I think it's exactly the same sort of thing here. But we've got to think about what can we do, what can you do to try and reduce these sorts of complaints? What can we build into systems to make this car safer to drive for the consumer that's going through the claims process? So this is some data from Marsh. They did their own deep dive into conveyancing because they were concerned about the scale. I think they looked at about £60 million worth of claims in conveyancing over a 3-year period, just over 1,000 claims. What was really interesting is what drives it. And about 40% of the value came from what they call requisitions and lender requirements, which I'll move on to quickly. There's 4 of these in particular, the dashes there. Things that conveyancing firms hadn't done, but are required by the Council of Mortgage Lenders when acting for the lender alongside the purchaser. And they're pretty simple things, but when they're not done, they lead to mistakes and they lead to negligence claims. Back-to-back transactions, owning property for less than 6 months, part of the purchase money not going through a solicitor, of course that must ring alarm bells, and variation in the purchase price between what's agreed and then subsequently what's happening. If we could just get those right, then we might take out a significant chunk of some of those claims in conveyancing, but of course there's others as well. So, as we've said, what are the root causes for this? Is it unqualified staff without adequate supervision, or is it qualified staff without adequate supervision? Poor risk practices. Is it not using systems for what is actually repeat commodifiable work? Is it doing it bespoke, where mistakes are made bespoke as long as the individual pieces of work? Is it pressure to hit targets and billing targets? Or is it simply that these are low-cost services with huge risk attached to them? I've heard some people say, and I think this rings true with me, that the risk in conveyancing generally, or the risk in house purchase generally, has all been loaded onto the conveyancing process and therefore onto solicitors and their indemnity insurance. We need to think about how we can try and get at those root causes and make conveyancing work more effectively than it does at the better. As we think about reforming professional indemnity insurance, we don't want to just get the costs down. We want to make sure that we've got the right protections, but also that we've got the right incentives to manage these risks within firms and to stop these things happening. Because the best way to reduce the price is to have less mistakes. And that's what we've got to try and do in some of it. And I think that our minimum terms and conditions at the moment don't always do that. And what they do sometimes is allow people to forget about the risks and think that they're insured. And that doesn't seem to me to be a healthy way to do. I'm sure lots of firms don't think like that, but you can see from the numbers too many seem to be. So we're trying to think about different ways of doing that. Our reform generally is about trying to get competitive forces into the legal market. That isn't, whatever people think, simply about lower prices. That's about different ways of working, better systems and controls that drive better outcomes for consumers, which is the successful completion of their transaction without a negligence claim being needed. I don't think any client ever chooses a solicitor because they're well insured. I think they choose a solicitor because you won't make mistakes, because you're well trained, you're ethical and you're professional. We need to make sure that the PI system, the minimum terms and conditions, help you stick to that rather than allow things at the wrong end of the market to slip out of it and lead to £2 billion worth of claims. So our aim is really to try and strike the right balance between consumer protection and lower costs that helps people innovate and grow their businesses. We want to make sure that the incentives are right, that we align the incentives of consumers and firms to do the right thing rather than to make shortcuts and make mistakes. We want to change the way insurers think as well. We want more insurers coming into the market so that you have more choice. And we want them to think about the way they structure insurance differently. So, for example, should we have different requirements on cybercrime insurance? Should it still be wrapped up with the MTCs, or should it be a standalone product for those that handle client money? Should we encourage the insurers to only write cover for cybercrime where people have taken certain steps to protect their business, like the windows and door locks that you might be expected by a house insurance to have if you've got high-value contents? And of course, we want to make sure there's much broader responses to reduce negligence claims in the first place. So, next steps. Well, this is the start. We want to talk to you. We want to hear your views. Really encourage you to download these slides from the website, have a read of them, think about what you want to do, what you think we should do, what opportunities you would have to insure your firm differently if there was more flexibility, what are the challenges you face in the market. If you think there's other evidence we should look at, let us know and we'll look at it. Our plan is to consult next year on proposals to reform the minimum terms and conditions. It's not simply about what's the right level of minimum cover. Is it 2 or 3 million? Should it be lower? But it's a whole package of how those minimum terms and conditions work. Should you get runoff cover if you haven't paid for it? Should you still be covered if you haven't told the truth? You've been negligent or misrepped on your proposal form. All of those sorts of things, we need to think again about the structure of those minimum terms and conditions so that we can get it to work for clients and to work for law firms as well. Thank you very much.
Well, time for some questions now. That was extraordinary. I really had no idea that the preponderance of conveyancing claims was so huge.
Don't move house is my main lesson from this. Don't move house.
Absolutely. But presumably, the rest of the profession is subsidising poor conveyancing in terms of their insurance premiums.
So it's interesting because insurers know this data, and certainly the biggest insurers have got 10 years worth of claims data themselves. So they know that firms that do conveyancing present most risk, and that'll be reflected in the premium. But at the moment, if a firm says, I only do family work on their proposal form, and the insurance company writes on the basis of that, but actually the firm does 50% conveyancing, the insurance company's still on the hook. Now, if I lie on my car insurance and say I only do 2,000 miles a year, or my son doesn't drive it, or if I lie on my contents insurance, well, I won't get cover. It seems odd to me that we allow people to get away with that and still get cover. And that does drive insurers' behaviour. So they'll insure you all as if you do a bit of conveyancing.
Really interesting. Okay, let's have some questions. First hand I saw was the lady in the second row. Microphone coming to you right now.
Hello. I think one of the key issues here is a point which you raised in your presentation, which is we do have a Rolls-Royce system of professional indemnity insurance in this country. There's no doubt about it. And the question is, do we say that's what we want? We want to be first rate. We want clients to know that if they come to a law firm and they are negligent or they have a dishonest partner amongst them, they will still be covered unless it's the sole practitioner. Or do we want to say it's not right for the rest of the profession to be subsidising the bad apples? And I think obviously, as you've mentioned as well, big firms will reinsure. So it absolutely makes sense to reduce the amounts. But the real question is, do we want to carry on with such wide provision at obviously a high cost because of the reputation of the profession?
So I think that's the issue, absolutely, but I'd ask it of a different bunch of people. I'd ask the customers. And I think that the customers will want different things in different circumstances. If I'm buying a house, I want that Rolls-Royce protection because it's probably the most important purchase that I'll ever do. But if I'm just going to pay £50 to get a lease checked for my son moving into a tenancy agreement or something like that, actually I don't want to put it up from £50 to £60 in order to have insurance protection like this, because if it turns out to be wrong, I'll just shrug my shoulders. I won't sue anybody over £50 worth of advice. So we've just got to be much more proportionate and targeted, and that might mean either we need different requirements for different people, or we need to give you the right combination of incentives, freedoms, flexibilities, etc. But it's the right issue, absolutely the right issue.
Okay. Next question. Yes. 2 rows behind. Sorry, I'm a little conscious that I maybe have been ignoring the back of the hall as well. So
it's one in the middle.
Okay. So
you can't see the lights.
It's sometimes a bit difficult to see. So I'll be looking that way after this question, I assure you. Okay.
A firm local to us was intervened on and he was struck off. It was a sole practice. I know he was fined, but presumably he hasn't got any run-off insurance because the firm's just closed down. Does that mean the rest of the profession cover that? I mean, he's got assets. How does it work?
So it will depend, but if adequate insurance wasn't in place, then the compensation fund can step in and there's a reasonable amount of that. The compensation fund will go after people for that as well. In effect, there's an abrogation rights in that. But, if the firms collapse, then often there isn't anything. So, in reality, other firms are paying for that and ultimately customers are paying for it. There's always a debate about things like it's large firms subsidising small firms or it's this type of firm subsidising this. The reality is it's good firms subsidising bad firms, and that's the only way to look at this. It's like any insurance. It's people that don't make claims subsidising people that do.
Okay. Back of the hall, I can see gentlemen standing up there. If we can get a mic to you. Oh, you got a mic. Yeah.
Brought one with him.
Always useful on a day like this.
Bring your own. Yeah. Mr. Passmore, I was very interested in your presentation, but I'm a little concerned as to what the message truly is. As you will all see, I've got a few grey hairs, and therefore I can remember the Solicitors' Indemnity Fund, and I can remember the debate we had about moving away from a mutual fund. I can tell you that one of the reasons we have this blue chip cover was because the Law Society at the time did not know whether or not the insurance industry would be remotely interested in insuring our profession, and there was a concern to make sure that there was maximum client protection. That is why we have the minimum terms and conditions. Your message could be interpreted as meaning that if we look to change things, the SRA can deliver lower premiums. I would be very, if I may say so, doubtful about that. I'd be interested to know what feedback you're getting from the insurers. You mentioned that there's 38 firms who are willing to insure. That is because they've indicated they're willing to sign up to the minimum terms and conditions. I think I'm right in saying, but you'll no doubt correct me, that probably over the piece since 2001, there's probably been around about 50 insurers. Some have come in the market, spent 2 or 3 years and then got out again. There's 1 or 2 who came in which would rather wish they didn't. So I'm very concerned that what your message is, and I think you've got to be clear about it. Is it that you can get, for want of a term, a better deal? Bearing in mind that, as I understand it, the LSB made very clear that we dilute client protection at our peril, unless they've changed their position. Or is your message that we've got to live with insurance and we've got to improve our act, particularly where conveyancing is concerned, when you've made clear that in terms of the reward for solicitors is wholly disproportionate to the risks that it carries? So I think it's very clear to me what this message is, and I'd also be interested to know to what extent insurers are even showing an interest in this.
So the message is really simple. The message today is, there's the data, what do you think? There's no proposals up here. What does it mean for price? Well, the SRA can't deliver you lower premiums. Only a competitive insurance market can deliver you lower premiums. We would say that as a starting point, if there's more flexibility in the market, you're more likely to get more competition. So what do we think with the insurers? Well, there's 2 or 3 things I can say. One is go back to 2.5 years ago when we proposed reducing the cover from 2/3 million down to $500,000. In the period between our board making that decision and the LSB saying you can't go ahead with that, one insurer advertised that if you reduced your cover from 2 million down to 1 million, they would give a 10% reduction in your premium. That was the insurer part owned by the Law Society. So we know that it can happen. That's only a small part of the market. What insurers say to us is, at first they said to us, you know, as you would expect, well, we know all this data and it's priced in. So if you take the cover down, it won't cost any less. So my answer is very simple. So if I put it up to 25 million, it won't cost any more. And they quickly realised that's a bit of a daft line to go down. They are now at a stage where they're engaged with us. They understand this. They're engaged enough to share 10 years worth of claims data with us, to be engaged in a discussion with us about what does this data mean and what other things can they share with us. I think it's very clear from talking to them that there's some bits they would like to change and there's some bits they'd probably not like us to change, much the same as for firms, much the same as for consumers. What we need to do is to balance all of that and say what's the right protection for consumers. It's not about, you know, gold-plated or not. It's what's the right protection for consumers, and that protection is almost certainly going to be different if you're a commercial client, if you're doing a conveyancing transaction, or you're just buying £100 worth of simple advice. It almost certainly needs a different amount of cover and a different set of terms. And us prescribing them in detail is almost certainly going to push up the price for anything other than the bigger claims.
Okay, Crispin, that answers the first part of the question. What about the second part? Are you saying get your act together and that will bring claims down? Presumably you are.
Yeah, absolutely. You know, if we can sort out the cause, then, you know, the price comes down. If there's less claims, the price of conveyancing comes down. If commercial and conveyancing were down at the prices of family and other, then the price of insurance would be down. What can we all do together to tackle that?
Okay. Next question. I'm looking. Yeah, gentleman in the third row. Microphone just behind you.
Francis Dingwall from Legal Risk. I have a question on your statistics.
Yep.
It doesn't sound to me, when you say we've got the data, you haven't got the data if you have excluded all the insurers who have left the market, and in particular those insurers who have gone bust, because they're the ones with the bad claims records, and that data needs to be in your statistics.
So that's right. What we've got is this data. And there's a few sources in these slides. There's SIF data. There's the 10 years worth of claims for 90% of the people currently in the market. And there's some other sources as well that are quoted in them. We'll keep looking for more data. We're looking at what can we get from those insurers that have left the market either in good order or in not so good order. And we're doing some work to try and work out how different their claims ratios are. Of course, they're going to be different. That's bound to have been part of the reason why they left the market. And that might twist some of this data or change the shape of some of this data. But the key is none of this data tells us what to do. All it does is give us better information to make slightly more informed decisions. It is still a series of judgment calls balancing, the right incentives, consumer protection, and the cost of insurance. And, I'm sure we'd all make slightly different decisions. What we've got to do is, hear a wide range of views, put those proposals to our board, agree a consultation, get some more views, and then come back and make some decisions. And, we won't do that on our own. We'll do that with your help and lots of other people's help as well.
Okay. I think your hand went up first, and then the lady at the end of the row.
Two things, Crispin. First of all, the data bears out pretty much what the insurance industry was saying, that the likely savings between a £500,000 premium and a £2 million premium isn't going to be that big because most of the claims fall at that level. And it also ignores the fact that we're buying as a block. We have purchasing power as a whole market buying the same. If we all buy individual little premiums, then that's going to cost more for each different type of slightly premium you've got. And the second thing that you skipped over rather quickly was the post-6-year runoff cover. And you've abandoned that as an organisation. But that means there are firms that have already closed that have no prospect of covering themselves against that. Firms that are closing, firms that will close, no policy on the market. And when you look at those figures, I think, because they went by so quickly, it wasn't a huge amount to cover. It looks like the money that's left in SIF would cover for quite a few more years, but you didn't linger long enough on the slides.
So the slides are online. As I said, there's 40-odd slides I wanted to get through in 30 minutes. I think clear, let's just get the facts right on it. The SRA hasn't abandoned post-6-year runoff cover. Post-6-year runoff cover when we went from SIF to an open market. That was a law-cited decision in 2001. What we were able to do at that stage was to use the surplus that was left in SIF to put in place post-6-year runoff cover for a fixed period of time. What the SRA has done is extended it once, I think. It's considered extending it again, but the actuarial advice that we've had from SIF is there isn't enough money to do it, so it'd be a bit mad to do that. It doesn't stop people coming up with other products to try and solve that issue beyond. What we've got to think about is where's the right balance on the length of cover in order to protect the consumer. With 6 years runoff cover, half of firms that close don't pay the premium. So making it a more expensive product is not going to solve that problem. So if we make it a more expensive product, all of you that are still running law firms are going to have to pay more for those firms that didn't close down in an orderly way. And I'm not convinced that's a good idea. Reducing the premium, well, as I said, what we do know is that very clear evidence. If you reduce it from 2/3 million to $1 million, then at least one insurer will cut the premiums by 10%. Others said in our response to consultation at that point that it might make a difference of 3 to 5 or 8 to 10%, depending on the insurer and who they're insuring. But it only needs one insurance company to reduce the price for the others to have to follow. That's the nature of competition, so we're confident of that. But we can't control the price anymore. We can control it from year to year. What we can do is make sure that there's the right consumer protection in place to look after the right consumers at the right time. And we don't have that at the moment. What we have is a blanket policy that means that sometimes you're underinsured if you stick to the MTCs. If you're doing commercial work, you're underinsured, and you're overinsured if you're doing family and other and those sorts of things. So rather than us say, we from on high know the right level of insurance for 10,500 law firms and 140,000 practicing solicitors, wouldn't it be better if we said you're professionals, you're ethical individuals, you know your business, you know your clients, you know your strategy, you know your risk appetite, you know the right level of insurance for you within this framework.
Well, But what about leveraging bulk purchasing power?
Yeah, it's an interesting argument. Perhaps we could do it for who you bank with and where you buy your stationery as well. Perhaps we could just nationalise you and have a national legal service. It's just not our job as a regulator to help you bulk buy services. To me, is just what a route to go down. I don't think you want me telling you how to run your businesses at all. You want to make them successful.
Okay. Lady on the end of the row.
Just an observation, really. Moy Mason Gordon Brown Law Firm. About 48% of our business is residential conveyancing. Set against the backdrop of Matthew Briggs' comment this morning that 90% of the people who visit his website, their first concern is price. My observation is that in recent years, solicitors are having to do more and more work per head in order to maintain some form of profit level. There's been the arrival of intermediaries within the conveyancing business. Well, estate agents are now making, by way of additional fee, for a referral fee, as much as the solicitor is making out of the conveyance. And whilst that situation continues and profit margins are so low, fee earners in conveyancing departments are doing more and more work under more and more pressure from clients who expect quicker and quicker transactions, and that's how mistakes are made.
Right.
I agree, and that's why we regulate conveyancing, that's why we regulate legal services, is to try and manage some of those risks and to set minimum standards. And I think one of the messages, as I said, is we want things to be put right so there's less of these problems. So we need to think about how do we regulate conveyancing to make sure that under those competitive pressures, it's not the quality of the service and the ethical and proper nature of that service that gets cuts, because consumers aren't in a position to spot that. So we need your help to get that right. How should we regulate conveyancing to try and reduce it? What I can't do is say the price is £700 instead of £400 or £1,500 instead of £900. That's not the game we're in. What we've got to try and do is make sure there's a minimum floor in the quality and how you work, and that there's appropriate insurance for when it does go wrong. But we've got to work together to try and solve that problem, because I agree with you. As I said, all the risk is loaded onto the conveyancing process in house purchase. I agree with that.
Okay, I think we've got time for a couple more. I'm looking at the back of the hall if I can see any hands raised. Yeah, see one there.
I may have missed something in the 40 slides that were flicked through before. But if the terms and conditions are reduced to a level of £500,000 compared to the standard 2 million, what benefit of that is to the consumer protection?
Well, it depends where you are in the process. I'm not suggesting 500,000 is the right answer. What I said was that's what we tried 2.5 years ago. You can see the data. You make your own call where it should be. 2 million, might be the right answer. It's arbitrary wherever you draw it, and it's almost certainly wrong for almost every case.
You're stressing consumer protection.
So if you're buying a house for 5 million, then 2 million isn't enough. If you're buying a house for 100,000...
A solicitor with 2 or 3 million won't take that case on in the first place.
So what you're saying then is the solicitor is quite well placed to judge what work they're doing and what level of cover they're doing. If you're capable of making that decision above 2 million, you're capable of making that decision above 1 million, and you're capable of making that decision above 500,000. Actually, I've got more trust in you to choose the right level of insurance. That's perhaps because we can see that half of law firms do already buy more than the minimum. Well, you're quite capable of making the right judgment for the sort of work that you're doing. If, therefore, you don't need 2 million of cover, you only need 500,000 of cover, then 500,000 of cover is cheaper. So wouldn't that be a better thing? Because that'll lower your costs. In a competitive market, I'm sure that'll help you lower your prices.
It would help consumer protection.
Well, it'll be exactly the same consumer protection. If they're only doing a transaction for 200,000, they don't need £500,000 worth of cover. If they're buying a £200,000 house, they need different consumer protection than if they're buying a £2 million house. Why would you buy a product you don't need?
Okay, I think maybe time for one final question if we have one. I'm just, we've got one at the back.
I have a confession to make.
Confess.
I've lived through a number of boom and busts and acted for financial institutions against solicitors. And incompetent solicitors are not competent to arrange insurance for themselves.
Agree. So I agree. You make a strong case for regulation. That's why I chose to become a regulator rather than a lawyer. So that's why I don't think that the right answer is to get rid of the minimum terms and conditions and say, yeah, the same as medics, get adequate and appropriate insurance. I think that there is a case for a minimum. It might be $500,000, it might be $1 million. I struggle to see what the case is for saying that you should benefit as a law firm from insurance you haven't paid for. I struggle to see the rationale for why, if you lie or you misrepresent fraudulently or negligently on your proposal form, you should benefit from insurance that you haven't, your quote isn't based on. I struggle with that. And I think actually, what you're doing then is you're relying on the competence of other people. So we've got to think about what's the right MTCs, what's the right way for us to deal with people that don't do it properly.
Okay, I think perhaps on that note, as you say, a strong case for regulation being made from the floor. Perhaps that's a good note on which to wrap this session up. And please show your appreciation to Crispin Passmore.
Thank you.